Welcome everybody to the spring budget webinar on what the recent budget changes to pension legislation will mean for you. My name's Nick Nesbitt. I'm a financial planning partner within the Mazars private client team. I'm joined by my colleague Natasha Ryan, who is a tax advisory partner within the Mazars private client team. Given the nature of the changes and how pension heavy they were, you'll probably hear a fair bit more from me today than you will from Natasha. I'm sure Natasha's relieved about that. But Natasha will come in later on to give a balanced and tax-focused perspective on the pension changes, and also to give you some wider updates on private client tax that we'll be seeing over the next week or so. So, without further ado, this is the broad agenda of what we will be covering today. So, we'll start by looking at, or we'll actually start with a brief recap of the pension landscape as it stands today, just to give us some building blocks for the detail that will then come in relation to these recent changes. We'll then go on to look at what's happened in the annual allowance space, before then the lifetime allowance changes we've seen, and then put that into some context around what we think these changes mean for our clients and for people out there, as well as some warnings around potential changes, etc. And I'm sure we'll get quite a few questions on those. As I said, Natasha will then give us a perspective from the tax advisor view on these pension changes, before then looking at some other tax changes, and also what wasn't in the budget, something we possibly expected to hear but didn't see much detail on in the budget. So that is that. In terms of some housekeeping points, there is a Q&A box. I can see a few questions in there already, so thank you for those. We'll come to those at the end, and we'll try and answer as many as we can. The session will be recorded, is being recorded, and will be circulated to all registered attendees tomorrow. And within that, there'll be a link to send in further questions or requests and contact with us. So if you've got any further questions that crop up beyond this session, or if there's any questions we can't answer, then please do get in touch via that method, or contact your regular point of contact here at Mazars. So let's start to dive into some of the pension detail. As I said before, I think this budget was surprisingly pension heavy. There were rumourings in the week before about increases to the lifetime allowance and changes to the annual allowance, but I don't think many people predicted the sort of wholesale changes that we have seen. So just to provide a bit of context to those changes as we come on to them, I just thought it might be worth just recapping on the sort of the general points that sit around pension planning here in the UK. I guess there'll be a few people on the webinar today that have probably given up on pensions a few years ago because of lifetime allowance or annual allowance constraints, and therefore some of this detail might be unfamiliar or a little bit hazy. So I'll just take you through these general rules of pension planning. So pension contributions, they're made personally, attract tax relief at your marginal rate of tax. So that could be 20% for basic rate taxpayers, 40% for higher rate taxpayers, 45% for additional rate taxpayers, or even 60% tax for those people caught by that nasty personal allowance trap between 100 and 125,000. And just to go a bit further into that, most personal pension contributions are made net of basic rate tax. So you get your basic rate tax relief through the pension scheme, and then you claim any higher rate tax relief through your self-assessment. If you're making company contributions, either as an employer or if you have your own company, then they are paid gross. So if you want to make a contribution of 20,000, you pay across £20,000, and that should attract corporation tax relief, subject to it meeting the wholly and exclusively test. Then there's no point in putting money into a pension if you can't get it out. So the rules around getting money out of a pension are that currently from age 55, you can access your pension benefits, with 25% of the fund typically being tax-free, and then the remaining 75% taxed at your marginal rate of tax. And I guess to some extent, the name of the game is getting tax relief at the higher rates in working life, and then getting the money out at the lowest possible rates in retirement, if indeed you need to get the money out. Since 2015, the ways in which you can get money out of a pension scheme have become more flexible. So there are still annuity options, and they're debatably slightly more attractive now in a higher interest rate environment. But most people we see still access pensions via drawdown. And basically, since 2015, you've been able to go and take what you like in the form of drawdown. So you could, if you really wanted to, I think it was Steve Webb who described the Lamborghini planning of, if you really wanted to, you could go and strip out your pension fund and buy a Lamborghini. Luckily, we haven't seen too many people doing that, but it demonstrates the flexibility that you now have. In terms of the underlying mechanics of the pension fund, the investments or the holdings you have in the pension grow tax-free, so there's no income tax on any dividends or interest received within the pension, and there's no capital gains tax on any growth achieved on those investments. And probably most interestingly for most people, pension funds sit outside of your estate from an inheritance tax perspective. So basically, when somebody dies with a pension fund, the pension is not part of the estate calculations, and the value of it is not subject to inheritance tax. If you die before the age of 75, then broadly speaking, the whole thing can pass to whoever you want, completely tax-free. If death occurs post age 75, then again, it passes tax-free. It passes down to your beneficiaries tax-free, but they then pay income tax at their marginal rate of income tax when they choose to draw down the fund. So it's still debatably more attractive than inheritance tax, where 40% can be taken away at the point of death. But the person there does then need to plan around their own income tax position. So hopefully that's just a bit of a recap for anybody who's a bit rusty on pensions. We'll now dive into what's actually happened over the last couple of weeks. So let's start with the annual allowance changes. As we stand today, still just about in the 22-23 tax year, the annual allowance, which is the amount that you can put into your pension each year without suffering a tax charge, is £40,000. Now, you do have to have earnings of £40,000 to be able to contribute that level. Otherwise, your annual allowance is capped at your level of earnings. But broadly speaking, the annual allowance is £40,000. And there is also this carry forward facility that enables you to go back up to 3 years and use unused allowances from those years. So in an extreme scenario, if somebody hasn't contributed in 1920, 2021 or 21-22, you could carry forward £40,000 from each of those years. Combining it with this year's 40,000, you could put in up to £160,000 gross to a pension in this tax year. However, for those people who we would sort of broadly class as higher earners, your annual allowance is reduced once you earn over certain levels. So the sort of general rule of thumb is if your income is coming in below £200,000, you should be okay. As soon as you start to go over that £200,000 of total taxable income, you start to get into this sort of range whereby the more you earn, the more your annual allowance is tapered, and then therefore the less you can contribute to pensions. At the moment, if your taxable income plus pension contributions is in excess of £240,000, then your £40,000 annual allowance is reduced on a 2-for-1 basis. So what I mean by that is if you had income plus pension contributions of £250,000, that would be £10,000 over that 240 limit. So you divide the 10,000 by 2. So there'd be a £5,000 reduction to your £40,000 annual allowance. So somebody in that position would only be able to contribute £35,000 without running into trouble with annual allowance tax charges. There is a de minimis limit to that tapering. It's quite low. It's £4,000, and essentially anybody with income in excess of £312,000, or I should say income and pension contributions in excess of £312,000, has that minimum £4,000 tapered annual allowance. So doesn't have a huge amount of scope to see their pension benefits grow any further. And then the last one in this sort of world of the back to work budget, as it was initially termed by the government, there was a big focus on the fact that people who had accessed their pension funds flexibly, so what that means is anybody who'd taken actual taxable income from their pensions, was then restricted to only putting up to £4,000 a year into their pension after that. And a lot was made around that sort of being another measure that made it unattractive to go back to work. So if we now fast forward to what happened in the budget, the bits in red are where there have been some notable changes. And these changes will come into effect from the 6th of April 2023, so a week or so's time. So the big change, and I don't think many of us saw this particularly, it wasn't sort of really a problem for many people, although we'll talk in a second about who it was a problem for, but they basically have taken the annual allowance up by 50% to £60,000 a year, and they've kept that carry forward facility. It's important to note with that carry forward facility that those years that you can now go back to from next year, the annual allowance will remain £40,000 for those years. It won't be £60,000 retrospectively for those years. Just to sort of a bit of a sidestep into why they've done this, in my opinion, I think a lot of it came from the problems that doctors were seeing. The way that the NHS pension and other defined benefit pensions work is that the growth in the pension is calculated differently, and it can be relatively easy to see pension growth in excess of that old £40,000 allowance. And what that had done is it led to a lot of doctors and medical professionals taking decisions about workloads and retirement that they might not otherwise have taken. And naturally, with the NHS in some difficult circumstances at the moment, the government were clearly keen to remove those barriers and try to encourage people to work the hours they want to work rather than work hours that their pension position dictated. So that's a bit of context. In terms of moving on to the second point, for me, this was a bit of a missed opportunity, really, in that the government chose to continue with the tapering of the annual allowance, whereas I thought it's a bit of a funny bit of legislation, really. It creates one of those inflection points where if you earn over a certain level, you get quite significantly disadvantaged in my mind. So it felt like an opportunity to simplify it, but they haven't. So let's move on. So essentially, again, if you're earning over 200,000, it's possible that your annual allowance will start to be tapered. However, because of the increase of the annual allowance to £60,000 and also the increase in the minimum tapered level to 10,000 from 4,000, you've now got this range whereby if your income plus pension contributions is between 260 and 360,000 pounds, you will see your annual allowance reduced from 60,000 to a minimum of 10,000. Anybody over 360,000 will just have that 10,000 pound annual allowance. Lastly, the money purchase annual allowance, which is that one for people who've already accessed their funds flexibly, has gone up to 10,000. So if you've returned to work, you've now got, or you are returning to work, you've now got the chance to put more in your pension. So that is the annual allowance changes. And I think they probably mean that a lot of people do need to rethink their pension contribution position, and we'll come on to that shortly. If we now come on to the lifetime allowance position, we'll start it with a bit of a visual, and I imagine the Q&As which are climbing up in the Q&A box have an element of this to them. But the big question on everybody's lips is the lifetime allowance a dinosaur, i.e. is it extinct forever, or is it a phoenix and will be resurrected over the coming years? We'll come on to explore that in a little more detail shortly. But to follow the same trend, I just thought it was worth recapping on where we are right now with the lifetime allowance. So as we stand today, a week left in this tax year, the lifetime allowance is a cap on the maximum amount you can have in a pension or across your pension benefits within your lifetime. And that level is 1.0731 million at the moment. If your pension benefits are deemed to exceed that at the point at which you access them, then a tax charge will apply. The tax charge is only to the excess amount. And depending on what you choose to do with that excess amount, the tax charge will either be 25% or 55%. But it has been a sort of a fairly nasty sort of surprise for some people at retirement. There is also, I should say, a secondary test at age 75, whereby if you've managed your position to retirement, you've taken your tax-free cash and you've avoided a lifetime allowance tax charge, if your pension funds then grow quicker than the income that you're taking out of them in retirement, then you can face a tax charge at age 75. There's another test, another assessment for the lifetime allowance. And we had a lot of clients who maybe retired in the early 2010s, 10 years or so ago, enjoyed the strong growth of the stock market. And so their pension funds have got a lot bigger, and they were sort of staring down the barrel of having to either pay a tax charge at age 75 or take a lot of money out of their pension fund and pay income tax. There were various lifetime allowance protections available. So just to give a bit of history, the lifetime allowance was introduced at 1.5 in 1.5 million in 2006. It increased gradually to 1.8 million, and then it started to come down quite significantly. And every time so first off, when it was introduced, some people had huge pension funds and they were given the option of these enhanced and primary protections. Then for those people who didn't apply for enhanced protection or primary protection, when the lifetime allowance started to come down from 1.8 million, there were these rounds of being able to apply for fixed or individual protection. And basically the deal with fixed protection was you could keep your lifetime allowance at the outgoing 1.8, 1.5 or 1.25 million pound level. But the quid pro quo for that was that you weren't allowed to contribute anymore to pensions. Individual protection works slightly differently in that it gave you your own specific lifetime allowance and you were able to contribute again. Fixed protection was probably the vastly more popular option, but there will be people out there with individual protection too. And crucially, there's always been a connection, well, ever since 2006, there's always been a connection, a link between the lifetime allowance and the tax-free lump sum you could have. And that link has been broadly 25% for everybody. So when the lifetime allowance was 1.25 million, the maximum tax-free cash you could have was 312,500. As it's come down, the lifetime allowance entitlement's come down to this £268,000 figure that we now have. So most people on the call will be aware of the first point. The lifetime allowance was abolished in the Chancellor's budget statement, which I think was the big surprise. None of us saw that at all. I personally thought that they might just re-link it with CPI, give everybody that 10.1% increase in CPI. Some people thought it would go back to the maximum it had ever been at 1.8 million. I don't think there were many people at all who thought it would be fully abolished. In terms of that sort of abolition, it will technically go out of legislation, we believe, on the 6th of April 2024. But the lifetime allowance tax charge, which is really the teeth of the beast, if you like, that's the thing that actually hurts you, is the tax charge, will be removed from next week, from the 6th of April 2023. And a lot of people have thought, what's that all about? But that's not an uncommon thing that you see with legislation change. It's all about it needing to pass through Parliament and the finance bills being passed, etc. So as far as you need to be aware from a practical sense, the lifetime allowance will be pretty much gone from next week, and it should be fully out of legislation by the 6th of April 2024. Whether it will come back again, we'll have to wait and see. In terms of lifetime allowance protections, now you could say, well, if it's been abolished, surely these don't matter anymore. And I think to some extent, there's some truth in that statement. But in this world of U-turns and ever-changing pension legislation, I would say there is still some underlying value in lifetime allowance protections because they give you some protected value above the standard lifetime allowance. So I think the government have been sort of fairly tactile in something that they've done here. They've said, as part of the legislation we've seen so far, that people will keep their protections if they contribute beyond the 6th of April 2023. And I think this is almost a nod from the government that there could well be a different government in power and they may well do some take some different actions when they come into power. So it's basically giving people that protection of, look, you can keep those protections that you had and take advantage of these new rules, i.e. the abolition of the lifetime allowance and some changes to the annual allowance. So that was quite an interesting development, I think, and gives people a bit of confidence about the risk of the Phoenix, and we'll come on to that in a second. Lastly, the tax-free lump sum. So at face value, you sort of think, well, that's fine. So basically, they've stopped saying the lifetime allowance. Sorry, the tax-free cash lump sum will be limited to 25% of the lifetime allowance. Because the lifetime allowance has gone, they've instead said the maximum tax-free cash that you can have will be that 268,275 figure, which is 25% of the current lifetime allowance. For me, this just, I don't want to sort of try and gaze into a crystal ball too much, but for me, this just gives me a little bit of worry about tax-free cash. Every year for the last 15 years at least, we've sort of talked about, will the tax-free cash entitlement go this year? And we've tended to say we don't expect it to, but clearly we can't guarantee anything, and it never has yet. I think that this disconnection of the tax-free lump sum from the lifetime allowance to a fixed number creates that potential opportunity for current and future governments just to gradually knock down the tax-free cash entitlement that you might be able to have. So it wouldn't surprise me, and clearly we can't guarantee any of these things, but it wouldn't surprise me if over time we start to see that number drop to 200,000, maybe 100,000. I think that's politically much steadier and safer than just a complete sort of removal of the tax-free cash. So nothing particularly to do on that front, but something to be aware of. So then lastly, as I've alluded to quite a few times already, the big sort of talking point at the moment is, well, this is great, isn't it? The lifetime allowance is being removed, the annual allowance is higher, surely we'll just all fill our boots with pension contributions now. And I guess the answer to that is yes, but Labour were very quick to come out of the blocks on the Thursday morning after the election and say, hold on, if we got in power, we would reverse all of this, but we would do something for the doctors because we appreciate that these rules don't really work well for the doctors. And this chart, I mean, I know there's a bit of political engineering going on here, but this chart just demonstrates visually that it's very much a conservative policy, and seemingly a Labour government would be quite against this policy and might seek to reverse it. So to an extent, you've always got to plan with the rules that you have today. And right now we still have a lifetime allowance. So we should plan on that basis. Next week, we won't have a lifetime allowance, so we should plan on that basis. And we should take some comfort from the fact that some of the rules that have been introduced so far have provided protection for those lifetime allowance protections. And equally, whenever there's been legislation historically that has brought in new caps, so a renewed lifetime allowance, they have come with one of those forms of protection. So there's a hope that if you took action over the next 12 to 18 months to make more pension contributions, then there is a hope that there would be some protection available if a lifetime allowance was reintroduced. Naturally, there is an element of uncertainty over that. And I think what we're saying at the moment is you just need to keep weighing up the pros and the cons of anything that you do and go into all decisions with sort of eyes wide open. So that's the Phoenix risk with the lifetime allowance. We now come on to what we feel these changes mean at the moment. And what I would say is the headlines are pretty clear. The detail, as ever, is quite uncertain, and we've got quite a few questions still to be answered over the coming weeks as legislation becomes clearer and how the rules are going to actually apply in certain situations become clearer. But I think overall, as I've said a few times, there hasn't been a huge amount of positive news in terms of tax rules of late. I think generally the climate we find ourselves in, there's becoming more and more of a squeeze on private client taxation. So this does feel like a bit of a celebratory moment and does create more planning opportunities and more scope for tax relief for a lot of people. I put a slightly facetious comment in the bottom right, but always plan responsibly. I think there is as I've said a few times, there are definitely some pitfalls that you could fall into or some risks that you need to consider. I certainly wouldn't go jumping into any significant planning prior to the end of this tax year, basically. So from a lifetime allowance perspective, what does that abolition of the allowance actually mean? Well, I guess first and foremost, it means something that a lot of people and a lot of advisors will have given a lot of mental consideration to. You can seemingly forget it, or at least put it in the bottom of the drawer for now. And the sort of second point is that most people should be considering starting contributions again. Obviously, you need to go and familiarize yourself with the rules, and we'll come on to that in a second. One of the sort of main outputs of the lifetime allowance was that it heavily sort of dictated people's retirement plans. As I've said already, a lot of doctors were leaving the profession, or certainly reducing their commitments within the profession. And the same happened elsewhere. Some people got to the lifetime allowance and thought that meant, well, I should retire now, which it was only ever a sort of arbitrary number, so it shouldn't have been taken as that. But people did do that. Equally, a lot of people, and we would have advised this quite a lot of time, would get to the lifetime allowance and withdraw their tax-free lump sum, for example, to stop any growth immediately going over the lifetime allowance. And it also dictated the order in which you took pensions. So if you had a mix of defined benefit and defined contribution pensions, you had to think pretty carefully about the order in which you took those. Now, in the absence of that lifetime allowance from next week, all of those things essentially go out of the window, and you need to look at it again and say, right, under this new landscape, what's the right sort of way for me to retire? What's the right thing for me to do with my lump sum? What's the best order for me to access my pensions? And actually, the order of accessing the pensions might now be driven by how much tax-free cash you can take from the different arrangements. And that's one of the bits of detail that we're still waiting on. And I think lastly, I alluded to that secondary lifetime allowance test previously. Naturally, without the lifetime allowance, there shouldn't be a secondary lifetime allowance test. So anybody taking pension income to manage the growth on their pension fund can seemingly stop doing that. I don't think we would say it's the end of people taking money out of their pensions. Naturally, some people will need it. And even if you don't need it, you might well say, well, I'm still going to take pension income up to my personal allowance, so about 12,500, or up to the basic rate tax band of 50,000, because I want to make sure I'm using those allowances. And if rules change in the future, I might kick myself that I didn't use that allowance or whatever. So we'd probably be having those sorts of discussions and saying, look, on the balance, still paying 20% to get money out of pension might be attractive for you. It obviously comes down to personal circumstances. But I think given the IHT benefits, and I know Natasha will come on to reflect on this a little bit, but the inheritance tax benefits associated with the pension funds, with the lack of a lifetime allowance, I think more people than ever before will just let their pension funds grow as effectively a trust fund that sits outside of their estate that can pass down to people on death. Keep going. So in terms of the lifetime allowance, again, I've just confirmed what it means. So for the masses, in inverted commas, there's a 50% rise to a 60,000 annual allowance. People should be thinking about whether they can and should be making full use of that 60,000, because if you can get highest rate tax relief on that and pay basic rate tax in retirement, then great, you've made a huge amount of sort of return, in inverted commas, through just playing the tax relief game. Even higher earners, they're still quite heavily tapered, but that allowance has gone up 150%. And people should think about adjusting their arrangements to make sure they're putting in £10,000 next year. This money purchase annual allowance is quite a rare thing, despite the government making quite a lot of noise about it. But if you're in that boat, then naturally, again, there's a 150% increase in what you can do. I think a lot of people will have opted out of workplace pensions over the last few years because of lifetime allowance concerns, or because they were so heavily tapered from an annual allowance, they just thought it wasn't worth it. So I think that's the first port of call, is saying, right, well, can I now go back into my workplace pension? That will usually come with some good tax relief in the form of income tax and national insurance contribution savings, if the contributions are done via salary sacrifice. And you'll probably also get some employer contributions. And I've got an example of that shortly. You need to remember that your contribution potential is limited to your UK relevant earnings. So I've had a few people who are retired coming up to me saying, great, I can put £60,000 into my pension now the lifetime allowance is abolished. And I say, actually, sorry, you can't. You need to have relevant earnings. Otherwise, the maximum you can contribute if you have no relevant earnings is that £2,880 net per annum, which creates the 3,600 gross. But in our view, most people should now be considering at least that bit of good housekeeping in the same light as doing your ISA allowance, etc. Remember the carry forward, even if you've not made any contributions for the last 10 years because you've had fixed protection, for example, you still have those carry forwards from those previous years, but you do also need to consider whether you had a tapered annual allowance in that year. And then the last point in red, touched on this a few times in different ways, but be very careful about any action that you're going to take before the 6th of April this year, so in the next week or so. A lot of people have jumped the gun and said, right, I'm going to put lots of money into my pensions. And I think our general view is now the government have come out and said, look, you'll keep your LTA protections if you contribute beyond the 6th of April 2023. That, for me, is a fairly clear sign that people in that boat should probably just hold off and do things next year. I think beyond that, our general rule of thumb would be probably don't undertake any significant planning now that you wouldn't have done 2.5 weeks ago. I think the legislation still is as it was prior to that. And whilst we don't expect any short-term U-turns, just be very careful about jumping into any planning in the short term, because the risk is that you just haven't considered every angle, and that in the future you find that, yes, you got a bit of tax relief, but it's made everything much more complicated or has some tax downsides. For those people who are caught by that personal allowance trap that we talked about, i.e. you lose 60 to 62% of your income that sits between 100 and 125,000. We think this planning, the increase in the annual allowance and the abolition of the lifetime allowance, will make it even more attractive to people to try and use pension contributions to get their adjusted income down below that 100,000. And one other thing that did come out of the budget was a signal that over the coming years there would be expansions and reforms to the free childcare that would be given to young families. A lot of that free childcare is predicated on neither of the parents earning over £100,000. So when you combine those two factors, the nasty 62% tax rate with the that extra 15 hours of free childcare, you can see a huge benefit to just keeping your income below £100,000. And then lastly, naturally, lots of clients we deal with have their own businesses and are very sort of focused on how they remunerate themselves. And actually, these changes, give you greater scope to contribute from your company. Naturally, you can now put £60,000 in from your company into a pension scheme. And when you combine that with the removal of the lifetime allowance, and a lot of business owners will have reached the lifetime allowance through previous contributions, actually, you're now looking at a very different landscape for company owners and how they remunerate themselves. One thing that a lot of business owners need to think about sort of in tandem with that is managing their dividend and salary position to that £200,000 threshold for tapering purposes. So that's a conversation we're having a lot already. What's my optimum salary and dividend mix so that I can also do the £60,000 pension contribution, etc. So a note of caution. I feel like I've given you most of the notes of caution so far as we've gone through, but I think just to summarize them, it's be very careful about anything this tax year. As a rule of thumb, probably don't do anything too significant that you wouldn't have done 2.5 weeks ago, because we still are under the same tax regime that we're under. We've just got a signal that things are going to change in a week or so's time. The second is the rules that sit around all of this are complex, and most people who are now taking action won't have really had to pay much attention to these rules for the last few years. So there is an element of spending time either yourself or with an advisor, getting to understand the rules, checking all the angles, and then making a decision. Again, just don't jump in. And then the last one is the Phoenix risk that we talked about earlier, the risk of a new government with a new set of rules, which sort of rode back on these sorts of changes that we've seen. And I think what we're saying there is, look, make sure you're going into any planning having considered some worst case scenarios, i.e. if they completely removed or reversed these changes, what position would I be left in? And would I still do the planning on that basis, given all the pros and all the cons? I think it's just a case of going in eyes wide open, because things will almost certainly change. They always do, irrespective of which government you have. So just having an eye to that before you do anything. I'm conscious of time and the fact I've talked for a very long time, so I'll just rattle through a few examples. So these are based on some clients that we've already sort of spoken to, and hopefully will resonate with people on the call. So this is Mrs. A. She's 50 years old. She's earning £150,000 and has pension funds of £980,000. So somebody in this position would likely have stopped contributing, because she would have been worried that she would have gone over the lifetime allowance with any further contributions, because she couldn't do anything about her lifetime allowance position until she got to, well, for her, it was 57. So there was a good chance that growth on the 980 would take her over the lifetime allowance over the coming years. So that decision to stop contributing for her meant she was foregoing 5% employer pension contributions. Under the new rules, she could well now rejoin the pension scheme next week, get her £7,500 of employer contributions, and also, if it's affordable to her, contribute £50,000 via salary sacrifice. That total contribution of £57,500 would sit within the 60k annual allowance. She would get roughly 52% tax relief on her contribution, meaning that for a net cost of £24,000, she'd have an extra £57,500 extra in her pension fund. Now, to sort of be fair with this, you have to sort of assess, okay, well, if she then was to take that £57,500 out in retirement, she'd pay some tax. She possibly wouldn't get any tax-free lump sum, given the new rules on tax-free lump sums. So if the whole of that 57.5 was subject to basic rate tax, she'd end up with £46,000 net in retirement. So if you do the maths on that, £46,000 net in retirement versus £24,000 net now is a 91% tax uplift effectively. So, I mean, obviously this example is designed to maximize that message, but actually that this is quite true for a lot of people, that you'll see a significant uplift through playing this higher tax relief in working life and then try and be a basic rate taxpayer throughout retirement. If we just move on to a business owner. So Mr. B is a business owner, 77, family business, so various members of the family in the business and contributing to pensions. His pension fund had got to a level where he was at the lifetime allowance. He took fixed protection back in 2014, has taken his tax-free cash, and now has a pension fund of 1.4 million. So as far as he was concerned, he was over 75, so he couldn't make any personal contributions anymore. And he thought that because of his fixed protection, he'd never make pension contributions again. Now, as of next week, he can potentially put in £180,000 of company pension contributions, using £60,000 for next year and £40,000 for the 3 previous years, assuming that he wasn't tapered in those years and assuming that level of contribution would pass that wholly and exclusively test. That £180,000 would attract corporation tax relief, £45,000 worth of corporation tax relief. I guess at a sort of non-numeric level, it diversifies the wealth away from the business and moves it into sort of IHT and tax efficient vehicle. The business could well qualify for business relief, so it might be IHT efficient itself, but it's a diversifier and it's removing money and getting corporation tax relief. If as an alternative remuneration strategy, he'd taken that £180,000 out through the dividend route, he would have got £81,000 net in his pocket. By comparison, even if he chose to take out the £180,000 from the pension and pay 45% tax, which is unlikely, I'd say, but if he did as a comparison, he'd end up with £99,000 net of tax. So again, a decent tax uplift without considering any investment returns or anything like that. So lastly, this is a sort of more straightforward and sort of unassuming example, if you like. Mr. and Mrs. C are age 58, both fully retired, no plans to return to work, got decent pension funds each and some other savings and investments. They previously assumed they were done from a pension perspective and that the budget news was not for them. To some extent, they were right. Actually, nothing in the budget changes anything for them. But what I would say, even for them, they should be making those de minimis 2880 net contributions each year, doing that all the way through to age 75. It might seem like small beer, but it's good housekeeping with very little downside. And what I've done there is I've just sort of said, right, if they did that, 2 of those contributions a year for 17 years, it would cost them nearly £98,000. But with the tax relief that's granted on those contributions and 4% investment growth, clearly can't be guaranteed, but seems a relatively safe or normal assumption, that would end up at 177,000. So in doing that, as much as it seems fairly small, and some people would say, can't really be bothered with it, there's about £25,000 of tax relief available there. And ultimately, removing that amount from the estate would save them about £71,000 of inheritance tax. So I think that's the end of me. I'm just going to pass over to Natasha.
Thanks, Nick. You'll be glad to know that mine's going to be short and sweet. Yours was much longer. So in terms of a reflection on the pension changes from a tax perspective, I would say, more than ever before, we need to seriously consider the IHT benefits of pensions and how these could impact people's estate planning strategies. A wealthy individual now may well be more inclined to use a pension pot, not for retirement income, but for an IHT efficient wrapper. This does mean that pensions are likely to become increasingly useful tools for individuals looking to avoid their death duties. And the danger, obviously, of this is that inheritance tax is often a political tax, and those affluent taxpayers looking to use their pension as a tax planning tool might find that the rules are going to change, as Nick mentioned already, following a change in government. In terms of the budget, apart from the good news around pensions, there wasn't really much else from a private client perspective. There weren't any changes to headline tax rates or allowances other than those that we were already aware of. And unfortunately, the ones that we were aware of were bad things, not good things. So the dividend allowance will be halved from £2,000 to £1,000. The capital gains tax exemption is also reducing from £12,300 to £6,000. And the additional rate income tax threshold is going to be lowered from £150,000 to £125,140. Interestingly, in Scotland, however, because they have different rules, some of their income tax rates have gone up, and they've gone up by 1%. To illustrate the difference between Scotland and England, our upper income tax rate is actually 45%, whereas in Scotland, from April, they'll be facing 47%. There were a couple of targeted pieces in the budget as well, which I thought might be worth mentioning. One was an announcement that income and gains from crypto assets will be needed to be reported separately now on self-assessment tax returns. And I think this highlights HMRC's approach to tightening the rules with these types of assets. The other measure, which I think is worth mentioning, and which is a welcomed one, is that the extension of separating and divorcing couples will extend what was quite a restrictive time period to transfer assets, capital gains tax-free, to 3 years now. And I think this will ease some of that burden and stress and complication that the tax situation has on divorcing and separating couples. So in terms of, a private client perspective, the budget, apart from the pensions, wasn't particularly interesting. But what wasn't in the budget was, well, hard to say really, but there's always speculation around capital gains tax and wanting to align capital gains tax with income tax rates. For the moment, we stay where we are, but who knows what will happen in the future. The other often speculated tax change applies to those individuals who own businesses, and this is to do with inheritance tax relief, formerly known as business property relief, but now known as business relief. And once again, there's been no changes announced, although over the years, lots of speculation about this. in the future, will this be considered too much of a generous relief? Like Nick, I don't have a crystal ball here, and I can't predict what's going to happen in terms of tax changes. But there's one thing that I was thinking about. There's a famous quote, the Franklin quote, that talks about nothing being more certain than death and taxes. And I feel a bit like that's not very apt these days. Yes, we're going to be definitely paying taxes, but there's nothing certain about our tax rules moving forward. And I think we're in this state of continued uncertainty. So in terms of that, there's nothing more for me to say. So I think, Nick, do you have any questions you want to answer?
Thanks, Natasha. Yeah, I was just going through all the questions and trying to pick out some common themes. Just one, which has come up a couple of times, just a clarification. People are questioning whether the tax-free lump sum is fixed at that £268,000 figure, or whether for those with protections, it remains 25% of their protected lifetime allowance. And that's right. For those with protections, you keep the same tax-free cash entitlement, which is the 25% of your protected lifetime allowance. That 268 figure is for people who don't have any lifetime allowance protection. So if you had FP14, where you had a £1.5 million lifetime allowance, then you'd still be able to access £375,000 of tax-free cash. Although I'd imagine most people in that position have probably already accessed their tax-free cash. So hopefully that's clear. There's also a bit of a niche question potentially, but it's certainly something I'm thinking about with a few of my clients. So it's something I raised. I think it was an anonymous question. So somebody who's saying they've already crystallized their pension funds up to the lifetime allowance. So they've used the full amount of their lifetime allowance, but they have this excess fund, which was over the lifetime allowance, and they chose not to put through the lifetime allowance test, i.e. they were just going to leave it and probably suffer a tax charge at 75, which was exactly what we advised people to do. So you might be a client of ours, in most instances, I should say. So the answer there is we don't know at the moment what legislation is going to say about that. My gut feel at the moment is that with the ability to crystallize next year, because there is still this concept of crystallization for next tax year, but a 0% tax charge, actually it might be an opportunity to take the risk out of that position, crystallize the funds, pay a 0% tax charge effectively, and know that you've been through that assessment should these rules get reversed. So please don't take that as a definitive answer at this stage, but I think that is definitely something to consider in the 23-24 tax year. So I'm just going to try there's another question from Steve here, which says, the reduction of the annual allowance from 60,000 to 10,000, and I think Steve's talking about when the money purchase annual allowance comes in. You've asked, does this only apply to taxable drawdown taken flexibly? The answer is yes. If you've just taken your tax-free cash, you haven't been deemed to access the fund flexibly, and you can continue to make the full contributions. You're not imposed, you don't have the imposition of the money purchase annual allowance. I hope that answers that question. Then there's somebody, as a retiree, it's a similar question, as a retiree drawing only from my defined benefit scheme, if I go back into the workforce and earn a salary, can I contribute to my SIP up to an annual allowance of 60k versus an MPAA of 10k? And again, similar question to that last one. Yes, because you've only ever taken a defined benefit pension, you're not deemed to have accessed pensions flexibly. And therefore, again, you have the full annual allowance subject to tapering rules, etc. And I think there's a lot of people, we have a medical specialism. I deal quite a lot with doctors, and I never thought we'd be talking to doctors about private pensions again. But actually, for a lot of doctors, I think that because a lot of them earn in that nasty personal allowance trap, but have about £40,000 of pension growth, actually that extra 20,000 of potential contributions now, they could well use that and mix their sort of defined benefit and defined contribution pensions. There's certainly doctors who have taken their pensions, gone back to work on the retire and return scheme, who I now think will definitely think about making contributions to a SIP or another defined contribution arrangement. So absolutely sort of planning to be considered there. I'm just trying to work on my feet here and go through all the questions that are coming in. There was a question here around whether these changes make it more or less attractive to take your tax-free lump sum. So previously, our general rule of thumb, it didn't apply for everybody, was that when you hit your lifetime allowance, you would take your tax-free cash, because if you didn't, the growth above the lifetime allowance would be subject to a sort of unavoidable, as we thought at the time, tax charge. Now, in the absence of the lifetime allowance, there isn't necessarily the same absolute sort of urgency to get the tax-free cash out. However, you do have to think about, if you don't take the tax-free cash, all the further growth that you're going to achieve on that money is going to move into the sort of taxable pot, because your tax-free cash entitlement, there's a fixed monetary amount, so any growth is going to shift into the taxable pot. So I think there probably is still a good case for taking your tax-free cash when you get to the lifetime allowance, or when you get to that 1.073 million, which was the lifetime allowance, I should say. I think there's also the question of inheritance tax, isn't there? If you were 55 and not in great health, then there's debatably little point in taking the tax-free cash, because it would bring it into your estate and run the risk of incurring the 40% tax on it. And if something happened to you pre-75, the whole thing could pass down completely tax-free. So I know this sounds like the answer you'd expect, but I think that sort of question really depends on your personal circumstances, your views on the various taxes, and your wider family position. If your spouse and your children are all additional rate taxpayers, then that leaves you in a very different position to somebody who's got lots of grandchildren who don't pay any tax, for example. So there's lots to think about in that wider planning. Just conscious that there's 5 minutes left, so I'll try and pick a few more. There's one here which is relatively straightforward, so thank you for that. It says, is the annual allowance limited to earnings, or can it be met from other sources, e.g. capital? No, the annual allowance, you have to have, for personal pension contributions, there's another question about that, so I'll go on to that in a second. For personal pension contributions, you have to have what's deemed to be UK relevant earnings. So really earnings from UK employment or UK self-employment, or so on and so forth. So you can't use dividend income, you can't use rental income, you can't use savings interest, you can't use capital gains. It has to be true earned income. Otherwise you're limited. Well, otherwise you're limited to the extent of your earnings. Or if you've got no earnings, it's that 2,880 net or 3,600 gross. On the other side of the coin, and linking to the other question, company contributions are not limited by the individual's earnings. So a lot of business owners will pay themselves a relatively minimal salary and take dividends. The company is allowed to contribute, well, whatever it wants, really. As I said a few times in the presentation, that contribution will go through a wholly and exclusively test. So for the contribution to attract corporation tax relief, it has to be wholly and exclusively in the interests of the trade. In our interpretation of that is that it has to be a reasonable sort of level of remuneration for the work done. If you're a business owner, you're running the business, making all the strategic decisions, etc., then that's not such a sort of a limited thing. You could argue that you're responsible for a lot of profits and therefore you can make contributions. It's more where you've got spouses or family members who are sort of involved in the business, but possibly if they weren't your spouse or child, you wouldn't pay them a £40,000 or a £60,000 pension contribution. That's where the revenue might challenge whether it's wholly and exclusively in the interests of the trade. Natasha, I don't know if you've got anything else to say on that. I feel like I'm slightly treading on your toes with that comment, but it looks like a no. But company contributions, I guess the answer to the question is company contributions aren't limited to the individual's income. They're more limited by the overall annual allowance, so the £60,000 limit from next year, and making sure they adhere to that wholly and exclusively test. Just seeing if there's anything else. There's just been a question come in around a large SIP with fixed protection. I think that probably comes back to that question I just had. Well, a few points I've just made. I would definitely be giving that some pretty careful consideration over the next 12 months. Just to explain, somebody's got a large SIP that's well in excess of their protected lifetime allowance, and so up until still the case, but up until the budget announcement, was expecting a sort of roughly £500,000 lifetime allowance tax charge, which now clearly has been removed. So that was a pretty good bit of news in this case. I would definitely be thinking at the moment about watching how the legislation develops over the next few weeks and months, and potentially looking at crystallising that fund next year. But again, please don't take that as advice. We don't know. I don't know your personal circumstances, but naturally, if you want to get in touch, then we're more than happy to talk through all elements. So I think there are still some questions coming in, and I can't sort of answer them all. Some of them are quite specific. As I said at the beginning, we've recorded this session, and we'll try and circulate the recording tomorrow. With that, there'll be an opportunity to get in touch if you've still got some more questions. So please do feel free to do so. We'll also be putting together a bit of a common Q&A document for our website on these pension changes. So that will also be circulated and put on our website in the fullness of time. But other than that, thank you all for attending today. I can see the participant numbers have stayed fairly constant, so you've all managed to get through an hour's worth of pension discussions, which is quite impressive. But I can see some people going now. But yeah, otherwise, have a good day, and if you've got any questions, do get in contact. Thank you very much.